City Retirement Systems Common Investment Meeting for September. It's September 17th, 2018. We're going to start by, well, let me just start with the schedule, and then we'll call the roll. So we're going to have our public session first, then we will convene in executive sessions, and then we'll take a break up here, and then do our caucuses downstairs as per usual. Okay, so with that, let's do the rolls. I'd like to start with the Fire Pension Fund and call on newly appointed Executive Director Patrick Dunn.
Thanks a lot. I'd like to really extend my appreciation to everyone and all the hard work you're doing here. I'd like to thank Commissioner Nigro, first of all, the unions, which know that I will also work diligently alongside the city in meeting the expectations of the fund. And with that being said, I would also like to conduct the roll for the city of New York.
Oh, the city, well, it's the mayor,
Phil Dukes
actually.
for Mayor
I'm
Bill
sorry,
de Blasio.
Mayor, I apologize.
Yeah.
And for that's
Hold on. Let us answer. Go ahead.
Phil Dukes for Mayor Bill de Blasio.
okay, we got Phil. I'm sorry. Okay, for the controller, Scott Stringer.
John Dorsa, designee for Controller Stringer.
Great. Okay, for Commissioner of Finance.
Jackie Gold for Finance Commissioner Jack Jiha.
Okay, for the UFA, we have Gerard Fitzgerald.
Pete DeVita, holding proxy.
Okay, Leroy McGinnis,
Pete DeVita, holding proxy.
Edward Brown,
Pete DeVita, holding proxy.
and John Kelly and yourself, Pete. You got the proxies for the grant?
Pete DeVita, yeah.
Okay. For the UFOA, Mr. Jack Kelty. Here. Mr. Liam Guilfoyle.
Here.
And congratulations to Liam. He is the new captain's rep for the Fire Pension Fund for the Fire Officers Union. And Mr. Paul Mannix. Here. And for Commissioner Terrell Brown. You can take Fire Commissioner's rep. Just so you know, she is under the weather. She is seeing a doctor. She will be here in a little while. Jackie, could you take the proxy? Would you be? Okay. So we have a quorum.
Thank you. Thank you. Okay. Next, let's do Police Pension Fund. Kevin Holleran.
Good morning. Representing the DEA,
Michael Palladino.
SBA, LBA, CEA,
Chris Monahan, designee Roy Richter, CEA.
Commissioner of Finance,
Cynthia Collins, designee for Jacques Jiha.
Mayor's Office,
John Adler, designee for Mayor Bill de Blasio.
Controller,
John Dorsa, designee for Controller Scott Stringer.
and the Police Commissioner.
Stephanie Zimberg, representative for Police Commissioner O'Neill.
We have a quorum.
Thank you, Kevin. Moving on to the NICERS. Karen Mazza.
Mayor's Office,
John Adler.
Controller's Office,
David Jetter for Controller Scott Stringer.
Public Advocate,
Larry Schimmel for Public Advocate Tish James.
Borough President Manhattan,
Algin Bonilla, designee for Manhattan Borough President Gail Brewer.
Borough President Bronx,
Martha Sabio, designee for Bronx Borough President Ruben Diaz Jr.
Borough President Brooklyn, Borough President Staten Island,
Isaac Gordetsky for Borough President James Otto.
Borough President Queens,
Alan Swisher for Queens Borough President Melinda Katz.
DC 37,
Raymond Santander, designee for Henry Garrido.
TWU,
David Katzman for TW Local 100 President Tony Otano.
Teamsters,
Ruben Torres for Gregory Floyd, Teamsters Local 237 President.
we have a quorum.
Thank you, John. John Adler.
Present.
Thomas Brown. Here. David Kazansky. Present. Lindsay Oates. Deborah Penny. Here. And John Dorsa.
Present.
We have a quorum, Mr. Adler.
Thank you, Thad. Okay, and then Burrs, Daniel?
Hi, John. We don't have a quorum. We'll vote on these items on Thursday at our meeting.
Thank you. That was Daniel Miller. Okay, so we're all present and accounted for. My crib sheet tells me that I have to inform the boards of the upcoming common investment meetings. The next one is October 17th, which is the normal date, the third Wednesday of October. However, in November, December, we're also doing Monday meetings, November 19th and December 17th, I believe because of the holidays that occur in those months as well. So mark your calendars. Okay, and with that, we will begin the content and call on Mike Haddad, I believe, to do the total quarterly performance overview. Unless Alex wants to start. You want to start,
thanks,
Alex?
John. No,
Yes.
it is Mike, but Mike will do an overview of the macro environment first, and then we'll do performance.
Great, thank you.
Good morning. So I'm going to start with market returns in Q2, and as usual, I'm going to divide my time, some part on what seems like ancient history, and then a little bit on current issues facing markets today. And as Alex mentioned, I'm going to talk about markets, and then together we're going to share performance data. I'm going to do the public markets, and Alex is going to do an overview. I'm going to do the public markets, and then Alex is going to do the private markets. So let's just jump in. And also, please feel free, any questions along the way. Don't let me get carried away and overspeak. So this is a familiar slide that lists the public asset classes in the first column, along with the returns. And so I would draw your attention to returns in the second quarter in the fiscal year ending June 18, and a few different takeaways from this slide. Takeaway one is the divergence in returns between U.S. equities and international equities, and both developed markets and EM markets. You can see in the second quarter, international equities were both negative, while U.S. equities were positive, and almost a 12% difference between EM equities and U.S. equities. Similar type of divergence in returns on the fiscal year, although we should note that all equity markets were positive, and given that's roughly 50% of your portfolio for the fiscal year, that's a great story. Last thing on U.S. equities I would draw your attention to, the last column, the expected return. And what that return is, when we did the strategic asset allocation in the fall of 16, that was the average U.S. equity return by all 5 of your consultants. And you can see over, and what that number was, and you can see the outperformance over the 5-year, 3-year, and fiscal year. So it has really been a remarkable run in U.S. equities for the past few years. Second thing I would draw your attention to is the poor returns in fixed income. In the quarter, long duration was positive, and that's because the long end was basically unchanged in yield in the second quarter. But if you look at the fiscal year, almost every component of fixed income was negative in the fiscal year, with the exception of high yield, which I'll get to in a second. And you would expect that in a rising rate environment. In the fiscal year, the 2-year note was up about 115 basis points, the 10-year up about 50 basis points, and investment grade was negative on the year, high yield was positive. The very broad market index for fixed income is called the Barclays Agg, and it was minus 40 basis points on the year. And that doesn't happen very often, and again, that's what happens in a rising rate environment. Last thing I want to do on this slide is the dispersion between investment grade and high yield. It's unusual to see one of these credit markets be negative on the year and one be positive on the year, and a couple drivers there. Investment grade is more interest rate sensitive, while high yield is more credit sensitive. And in a rising rate environment, again, you would expect investment grade to underperform. And high yield really benefited from the recovery in energy prices, which helped energy credits, which is a large proportion of the high yield market. So that's the quarter and the year, and let me delve into a couple drivers of returns in the U.S. equity market, as well as the divergence in foreign markets. So the U.S. equity market benefited from continued strong profit growth and continued large-scale equity buybacks. So this slide shows the earnings growth year over year in the second quarter as compared to year over year in the first quarter, and you can still see in the U.S. equity market strong earnings growth and accelerating into the second quarter. So that is consistent with strong performance and to be expected. In the international markets, still strong profit growth, but you can see it's decelerated quite a bit. And again, this is just year over year going into second quarter. A big part of the equity market return has been fueled by buybacks. And what I'm showing on this slide on the right, there's two bars. The darker shaded blue is the amount of share buyback authorized by the boards of public companies, and the lighter blue colored is how much was actually executed. I'm going to just just compare the dark blue bars. 2018 is expected to be about $1 trillion of stock buybacks, and that's just an extraordinary number outright as compared to the last few years, and that's been very helpful for equity markets in the fiscal year. So international markets, a different story. And what's really hurt their performance in both the quarter and the fiscal year has been this accelerated talk about tariffs and global trade. And when you think about the basic GDP equation, GDP equals consumption plus investment plus government plus net exports. It's the countries who have high net exports as a percent of their GDP that are going to suffer more. U.S., as you know, has a trade deficit, so it detracts from our GDP. So it's almost like an accounting equation. It benefits those who have net surpluses versus those who have net deficits. So it's logical to think that it's going to hurt international markets more than the U.S. So let's first start with the dollar over the quarter, because this impacts your international portfolios. As a reminder, current policy is to not hedge foreign currency exposure, so the dollar is a big driver of the international equity markets. And against developed market currencies, the dollar was strong. The shaded area shows you Q2. Even more dramatic was the performance of the dollar versus emerging market currencies, down almost 9% in the quarter. This slide shows the divergence in returns between U.S. and global markets. The white line in this graph is the S&P 500. The orange line is a weighting between developed market and emerging market equities. And you can see the shaded area is the quarter. And I also wanted to show you where this was as of, I think that was last Thursday. So this divergence has continued, and it's logical given the trade concerns going on as well as the rally in the dollar. Last slide on Q2. So I wanted to just show you the impact of currency returns on your portfolios. The second column is your return in Q2 in dollars. The third column is return for the fiscal year. And then following both of those is local currencies. So what does that mean? So for EFI, for example, it's heavily composed of European stocks, so the euro currency, Japanese stocks, the yen, UK stocks, the pound, and so on. So if one had invested from the perspective of one of those countries, and that was your local currency, your return would have been positive in the second quarter. And you can see the return in the fiscal year is not so much because the dollar didn't do much on the fiscal year. But it just shows you the divergence that you get when the dollar has big moves. So before I go into this concludes the part on market returns the second quarter. Let me pause for any comments or questions before I get into current issues.
Questions for Mike on these slides? Okay. You answered all the questions.
So here I've listed a handful of global macro issues facing markets. I'm going to go into greater detail on U.S. monetary policy and the U.S. equity market, but let me just make a couple comments on a few things that happened over the weekend. So trade and tariff, it seems that some resolution is in place between the U.S. and NAFTA, so Mexico and Canada, and the European Union. China remains an issue, and the Journal had a story over the weekend that the administration plans on announcing another $200 billion in tariffs. One caveat is the tariff rate looks to be 10% instead of 25%, so you can kind of almost call that good news. Again, it's a Journal story, it's not an official source, so we don't know on that. On Italian politics, the Italian government released their budget over the weekend, and it's a very fiscally conservative budget. So unlike some of the worst fears, it appears the budget is going to be not so fiscally expansive, and Italian assets are having a nice rally today. So that concern for the day has dissipated. And I want to spend a quick second on emerging markets. As I showed you in Q2 and continue on, they've dramatically underperformed, and the two poster childs for underperformance are Turkey and Argentina. And they carry a couple risks in markets, emerging markets that are front and center. One, they have a current account deficit, and two, they have a high proportion of their debt denominated in dollars. So what does that mean? That means when their currencies go down, it adds to the stresses in their market. It makes it hard for them to pay back their debt in dollars. So for examples, Turkey's currency has depreciated about 50% over the last 3 months. Argentina, something similar. And to fight their currency depreciation, Turkey raised rates last week by almost 6%. Their short rates are now 25%. Argentina has short rates at 60%. They're negotiating with the IMF for a package. So those countries, as part of the EM complex, are not big components, but there's always the risk for contagion. Turkey has almost $500 billion of debt outstanding, and if they were to default, which I don't think anyone's predicting, but given who's the head of the country, it's unknowable. So let me go into U.S. monetary policy. And what I really want to frame a question is, as we all know, the Fed's raising rates. So what we don't know is how many more times they're going to raise rates, at what level are they going to stop, and what's their plan with balance sheet contraction. So it leads to a question that you've probably seen in the financial press about the flattening of the U.S. yield curve, and is it signaling a recession? So what I'm showing on this slide is the 2-year, 10-year yield spread, as well as the gray shaded bars are areas of recession over the last several decades. So the 2-year, 10-year spread is simply the difference in yield between the 2-year and the 10-year. If you extrapolate where that graph is today, it's somewhere around 30 basis points. So what that means, the 10-year yields 3%, the 2-year yields 270, so the difference is a positive 30. So the theory would be, as the yield curve flattens, and you can see how it flattens means it goes lower in yield and the yield spread compresses, it's getting closer to zero. And if you go back and look at previous recessions, you can see the pattern that it's done. It's very similar. So it begs the question, is this signaling a recession? And if it is, what are we going to do about asset allocation, both strategic or tactical? Because if it's signaling a recession, that means things are slowing, earnings are going to slow, equities are going to go down, the Fed's going to raise rates, the dollar's going to go down. It's a whole bunch of things change in capital markets. I'm going to argue that this is a misleading signal at this time and point. I believe that the front end of the market has reacted as one would expect with the Fed raising rates. In the fiscal year, the funds rate is up almost 75 basis points. The 2-year note up 113 basis points. All makes sense. It's the 10-year and the long end that's really confusing. So let me get into that a little bit more. The Fed itself published a thick academic paper arguing that this yield curve, the 3-month to 18-month yield curve, is a much better indication of market expectations of recessions than the 2-year, 10-year. The front end is very, very much captive to monetary policy, while the back end has a lot of different factors that influence it, particularly international markets and international developments. So what does this spread indicate? If you think about it, it's the very short end of the market, 3 months, versus 18 months further out. This really captures what the market expects the Fed to do. So when this curve is positive, it means the market expects further rate hikes. When this curve is negative, the market expects rate cuts. And when the market expects rate cuts, that's typically when the economy is headed into recession. And again, the same gray bar is indicated as the recessions. And you can see how this spread has gone negative into each of the recessions, and this curve is still positively sloped. So this would argue that the 2s-10s curve is not a good indicator. A second argument is term premium, and this is really a technical bond market geeky thing, and to explain it, it's the additional yield for extending duration given all the short rate expectations built into the market are actualized. It's not simply the shape of the yield curve, because it includes what forward rates are included. So without getting into the technical definition or trying to understand it, what I'd urge you to do is look where this is now, where it's been in history, and it just tells you that the additional yield investors require for extending into long duration bonds is very, very, very low. And that kind of speaks to why the 10-year note and the 30-year are so low, given where we are in the economic and inflation cycle. begs the question, why is this like this? I would argue two reasons. One, quantitative easing. You've heard me carry on about it over and over. While the Fed has stopped quantitative easing and is actually tightening, the other central banks still are. And again, I've carried on with this many times with you before. March of 17 was the peak in global quantitative easing, and in November of this year, it's actually going to turn negative. So I would expect this term premium to go higher over time. Another reason why I don't think the 2s10s is signaling a recession is typically a recession starts when the real funds rate, and that's defined as the Fed funds minus inflation, gets to something positive. I didn't do the grade bars here, but we know when the recessions were. They were 08, they were 2000, they were 94. You can see back in those time periods the real funds rate was positive and as high as 2 to 4%. The real funds rate is still negative. So while the Fed's raised rates, it hasn't raised rates as quickly as inflation has gone up. So this would indicate that the Fed is not restrictive and they're not harming the economy as of yet. Another slide arguing markets are very accommodative. So this is the Chicago Fed Financial Conditions Index. Let me walk you through what the theory of financial conditions are, some of the minutia of what this index measures and why it's important to where we are today. Financial Conditions Index theory would argue that it's the culmination of many financial market variables that really drive the economy. And it's not so much the funds rate, but it's how the funds rate moves these other variables that drives the economy. And this index captures about over 100 different financial markets. It captures them in the front end. It captures them in the credit market, the equity market, the dollar market, and the banking system, and the shadow banking system. So this is a very broad index. And broadly speaking, when that number is up on the graph, tighter, that slows down financial markets, and that impacts the economy. And the opposite when it's lower. So very simply, think about the equity market. If the equity market is high, it's bullish for the economy. Consumers have more money to spend. Companies can raise equity more cheaply, and it fuels growth. And the opposite would be when it's lower. So again, while the Fed has raised rates during this cycle, financial market conditions remain at or near the most accommodative place they've been throughout this cycle. So that again argues for the 2s10s curve is not indicating a recession. I also listed as one of the ongoing concerns the breadth and the earnings story in the equity market. And let me expand on that by what I mean. So the top of this graph, you see the returns of the Russell 3000, very positive. And then I listed the so-called FANG stocks and what percent contribution to the return of the equity market they've included. So you can see both in the second quarter and the fiscal year, they've accounted for over a third of the total return in the equity market performance. Of course, the Journal had a story today refuting this and saying that breadth. This is called breadth of performance. That breadth was not concentrated, and one of the stats they cited was. I believe in 2000, the top 10 stocks accounted for 50%, and now they only account for 40%. So this isn't a bubble, but as we know, in 2000, that was an extraordinarily bubble that we hope we never see again. So this is a source of concern for markets. Second thing I would say about these 5 stocks is the second part of the slide lists the performance they've done in the fiscal year, as well as some very simple valuations. And you can see the returns in the fiscal year were absolutely fantastic for these stocks. Their market caps have grown to very, very, very large numbers. If you look at Apple, it's got a market cap in excess of $1 trillion. It's hard to grow a $1 trillion company at 20%. As great as a company it is, valuations at some point catch up to these stocks. And the last column is the price to earnings ratio. And while Amazon has traded at an enormous multiple for the last decade, it still is at an enormous multiple, and it's again hard to make money. It's hard for your stock to perform when you're at that kind of ratio, and either they have to start making money or that stock price has to come down to change that multiple. Further concerns in the equity market is the earnings per share growth. Now, I started off telling you how great earnings were, and now I'm going to tell you going forward, earnings are going to be lower. Is this some kind of macro prediction on my part? No, this is simply the tax cut. The corporate tax cut, which hit in late 17, is going to fall out of the year-over-year numbers. That was 10 to 12% of earnings growth over the last 4 quarters, and that number is going to mathematically just fall out of the earnings growth going forward. So you can see this is consensus numbers. 18 for the Russell 3000, 2018 growth looks to be at 19% in earnings. That's going down a lot in 2019. At some point, the market's going to pay attention to that. And the other takeaway from this slide is the valuations in the far right side of this graph to show you how rich or expensive, if you will, the U.S. market is versus its counterparts. Again, in the beginning part, I talked about buybacks being a positive, and now I'm going to say buybacks are a concern going forward. This first graph shows you the black line is the buybacks to date. It's been about $700 billion, with the markets expecting that to be about $1 trillion. That dotted red line is the 3-year average between 2015, 16, and 17, and you can see that number is closer to $500 billion. So buybacks in 2018 are about double what they've been over the past 3 years. Can it continue? I'm not going to say yes or no. It's just a fact pattern. And the last point is what this slide shows is the percent of buybacks by sectors. And it's kind of hard to read. It's pretty small, but the black one on the left is technology, which was almost 47% of the total buybacks. And I talked about the FANGs and their outperformance versus the rest of the market. And this adds to the source of concerns for the U.S. equity market going forward. That's it for the scary stuff. So again, I'll pause there for any questions or comments.
Questions or comments for Mike? Yes, Mr. Rodriguez.
I'm back. Anyway, so kind of a broad perspective, we've been hearing for a while now that, kind of earnings, the Russell 3000 generally kind of cannot keep this pace up, and yet it kind of still has. Where, and with kind of, the term premium kind of being low, where else will money go? I mean, like, it's still kind of flowing to the U.S. Equity markets. My feeling is that, like, if the term premium was higher, maybe people would kind of pull back, but there's where else will money flow to if not to U.S. stocks for the next, kind of couple of years?
I think a candidate would be international markets, given their relative less expensive metrics. So that would be one answer. I believe term premium is going to rise as the ECB is cutting in half in the fourth quarter their QE, and it ends at the end of 2018. The U.S. is going up another stage higher in the fourth quarter for quantitative tightening. So I think term premium is going to rise. Second observation is, given the amount of buybacks. And the other thing, in international markets, there are no buybacks. If they are, you can count them on one hand. It's a U.S. phenomena. So why does it exist, and how is it funded? So I don't want to get into why it exists. One could argue it's because the C-suite of executives are paid on earnings per share growth, and this is financial engineering. But how they're financed is a good question. I forget the exact breakdown, but the bulk of it is through investment-grade issuance. So corporates have relevered to buy back shares. So leverage ratios are higher. Interest coverage is lower because rates are so low. So as rates rise, if they rise, interest coverage ratios are going to get worse. And the fuel for buybacks has been investment-grade issuance is not going to be there anymore. The second place that they've funded their buybacks is through cash flow. Earnings have been positive, but a big chunk of that was the tax cut. And then that flows out of year-over-year numbers. It still exists, but in terms of growth, that comes out. So, given the divergence in equity markets, it seems to me either international markets have to catch up to close that gap, or the U.S. equity market has to go down to close that gap. That divergence does not remain in place over historical periods.
Any other questions for Mike? Okay. Thank you, Mike.
Thanks, Mike. So now we'll turn it to performance for the systems for the second quarter and the fiscal year ended June 30th. We begin on this page just highlighting plan assets in aggregate and by system for the end of the fiscal year. In aggregate, approximately $195.8 billion, and then you see the breakdown for each system. So now performance. And as Mike mentioned in his remarks, it was a mixed quarter, meaning we witnessed a divergence in the performance of the U.S. equity markets, which were strong, and yet we had weakness in foreign markets and foreign equity markets. And if you look at the 3-month column kind of at the middle of the page, you see that those dynamics were reflected in our results. So if you look at the returns by system, they range anywhere from 0.57% to 1.05% for the 3 months. And if you look below that, at the bottom of that same 3rd-month column where we give you a comparison of the system's results versus the index, the first column being an index portfolio, 65% equities, 35% fixed income, you will see that for the quarter, there was some underperformance for the systems versus that index portfolio. So what is driving that? And I will tell you that in addition to what Mike mentioned with regards to the dynamics of the markets, if you look at versus the index, what's driving that underperformance for the systems is that this index, which is 65% equity, let me tell you the components of that. So the components for the index are about 43% U.S. equities and 22% EFI. Now, if you look at the systems, and I'm just going to say in the aggregate, we're about 50% equities. But if you look at our breakdown, the systems breakdown is approximately, if I just blend the 5 systems, 30% U.S., 12% EFI, but 8% emerging markets. And you'll remember, as Mike mentioned, the emerging markets were down 8% for the quarter. So that leads to some of the lag in the performance for the 3 months. However, if you turn to the fiscal year, not only have the systems continued to outperform the assumed rate of return of 7%, but they are also meaningfully above the index portfolio, which logged in a 7.64%. And also for many of the systems, they were ahead of the larger universe of plans as measured by the Tux universe. I will note that the Tux universe reports on a gross of fee basis, and all of our numbers here are reflected net of fees. So, certainly over the last few years, several years, we've enjoyed returns that are above the assumed rate of return. And we are concerned, as we've mentioned actually for the last several quarters, that we are entering a period of moderating returns, higher volatility. And for those reasons, you see the results of that on asset allocation. And as we've mentioned in prior quarters, what that means, it's some of that concern that we've been in an extended run in growth assets, is that you will see us taking a more defensive position in the portfolio and de-risking the portfolio. So on this page, with asset allocation, you see some of those movements by asset class. And let me just remind you about how this page works. If you look at the vertical bars, the gray bars, those are our rebalancing ranges. And we will always be within those, approved rebalancing ranges in the tilts that we may take in the portfolio quarter to quarter. So to your far left, you will see U.S. equities. It is shaded in red with a downward arrow. And the shading and the arrows indicate kind of views and sentiment of the team, of BAM, with regards to the asset class. So U.S. equities, given the outperformance that we've seen and that Mike highlighted, not only do we have a more cautious and negative view with regards to the U.S. equities continuing to extend that run, but you see that we are underweight U.S. equities. Now you look further kind of to the right side of the page, the other area shaded in red with a downward arrow is high yield. Now high yield is at its target asset allocation, but the bias in high yield is negative going forward, so you may see that trend down and go underweight given our views on high yield and our views on just tightening spreads in the market give us a more cautious outlook. Now let's look at the two areas of green, and they are foreign equities. And Mike alluded to this, I think, in an answer to a question that we had as to where may capital go going forward. So right now, as Mike mentioned, foreign equities have been beaten up. You know, we had a very tough quarter in emerging markets. So when we look at either EFI or emerging markets, we see two things. First of all, meaningful underperformance. So that gives us a positive bias going forward. But also the valuations in those markets are attractive relative to the U.S. markets. So we have a positive bias in both EFI and emerging markets. So now we have inflation protection and the more defensive part of our portfolio. And what we want to do and continue to do is to ensure that we have enough inflation protection as we enter the period of inflation risk. So I just highlight the one area in the middle of the page was bank loans. So bank loans, as you'll see, is not only shaded in green, but also an upward arrow. And that's an asset class that you may see over the ensuing months and quarters that we may take up and go overweight in that area, as we certainly find those markets attractive in a rising rate environment. So what is the other side of the equation, you may ask, and we've mentioned this before, of our overweight to U.S. equity, underweight, excuse me, to U.S. equities. If you look at the far left, we have our Treasuries portfolio. And what we've done is that in the Treasuries portfolio, we are overweight short duration Treasuries. And that's the phenomenon that we've seen, that's where we have our tilts. As a counter to being underweight U.S. equities, we are overweight short duration Treasuries. Now, if you look at mortgages and investment-grade credit, those are areas where we have more of a negative view, more cautious view and bias to the downside. So you might see those asset classes, given the current environment, tight spreads, negative outlook, being underweight going forward. So what does that mean for duration? So obviously, as a result of our current overweight to short duration Treasuries, it should be no surprise what you're seeing on this page. So once again, the gray bubbles are our actual duration. And the blue is being our long-term target. So we are currently below our long-term duration target given the tilts that we have in short duration Treasuries, meaning being overweight short duration Treasuries. Now, you should expect this trend to persist in the near term as we continue to expect short-term Treasuries to outperform in this market environment. Now here we turn back to overall portfolio results for the fiscal year, and these are by systems. You will see, as I've mentioned at the top of this section, that each system has outperformed the assumed rate. But in addition, the systems have generated excess return above each of the system's respective benchmarks. So that's what you're seeing in the far right-hand column, excess returns. You've seen these graphs before. We break down that excess returns into its components. And you will see, no surprise, that the primary driver of that excess return is manager value add. And certainly over the long term, we would expect your managers to outperform their benchmarks over the long term. Now you'll see in the middle of the page, asset allocation, there's kind of a little bit of movement there. Certainly over the long term, we wouldn't expect asset allocation to be a driver of excess returns. But given the tilts that we've taken in the portfolios, I explained in the asset allocation pages, in the near term, you may see some movement here with regards to asset allocation and its contribution or detraction from excess returns. So with that, I'll turn it back to Mike for some commentary on some selected kind of public market asset classes.
Alex,
and
can
John?
we see if there are questions for you on the presentation you just made? Questions for Alex? Because I actually have a question myself. Turning back to the the asset allocation on high yield, which is slide 21, I think. Yeah. So my question about that is, when you say we're at the target asset allocation, I remember when we had the discussion about high yield implementation in the spring, we were below the target,
right,
and intended to stay below the target. So, because I think the target, we raised it in the last asset allocation. So my question is, are we at the target, the asset allocation target now? And if so, how do we get there?
The answer is yes, but that's based on the adjusted target allocation. What I mean by that is the placeholders as well. So let me mention bank loans. So bank loans, we have a series of 4 placeholders for bank loans, one of which is high yield. So if you look at bank loans, and this is a bit of a reclassification issue, and I'll turn to that as well, you'll see in the page, asset allocation page on bank loans, if you see a slightly below target, that has to do that part of the placeholder for bank loans is high yield. So you see that reflected, on the high yield page. So it shows us at the target allocation, including the placeholders.
So in terms of this whole thing, the placeholders are shown in their whatever asset class they're actually in, not as placeholders.
That is correct.
Okay. So just one other question on this. On the fixed income stuff, so that's slide 23. It looks like you want to go down in mortgages, but it also looks like we're at the bottom of the range. Yeah, that one. So how does that work?
I think there what we're saying is that we are currently towards the bottom of the range. I don't think we're exactly at the very bottom. I think the bubbles kind of, go to the very bottom of the bar. So it might be just the optics of it. But certainly the view is a negative view on mortgages, just given the markets. So certainly that is just the perspective. That's why it's red and shaded. And we have quarter over quarter, John, if you look at this chart from the last quarter or the quarter before, we would have been closer to the target allocation. So as have been rebalancing and tilting the portfolio, mortgages has been more and more underweight quarter over quarter, and we are approaching the bottom end of the range. We won't exceed the bottom end of that range. If we were to think that was prudent, certainly we would come before the boards with that recommendation.
Okay, and then, sorry, just one more question to the next slide on duration. So we have talked about the fact that we have this, we created these long duration targets when we did the asset allocation a couple years ago, and that given what's happened with the rising interest rates, it doesn't necessarily make sense to go all the way there. My question really, it's not a concern, it's just a question, is, in Mike's earlier presentation, there are some indicators that indicate that the bull market may be coming to an end. And the point of going into long duration treasury was as a hedge against that. So instead, we're in a much, much shorter duration, especially for the 3 funds that chose to go all the way on long duration. The 2 funds that didn't, they're a little bit closer to their target, but they're, quite short. And so, if you would, talk about, and I don't know, Alex, it's you or Mike, but the risk of going long, or the cost of going long, that's a better word, versus the risk of staying short if we encounter an end to the bull market, essentially, and hit a correction. Because that was the point of going long, was as a hedge against that.
So we talked about this either at the last sim or the previous one, I can't remember, but there's a few different ways to measure the riskiness of your treasury portfolio. Duration is one of them. Another is dollar value of a basis point.
I'm not sure your thing is on. Is your thing on?
Is that on?
Yeah, that's better.
Maybe I have to get a little closer to it. I'm afraid of it. And the dollar value of a basis point has actually increased, which is another way to measure the riskiness of your portfolio. Let me step back. What have we done? We have reduced equity exposure and increased short duration treasury exposure. By doing that, that shrinks the duration of your treasury portfolio from a duration standpoint. We're adding more to the short end. We have not sold any of the long duration assets whatsoever. So that plan reached about 50% of where it was supposed to get to, and we hit the pause button on it because of the flattening of the yield curve and the inflation risks that we don't think are reflected in the back end of the bond market. So that we owe you, and Robert and fixed income team are going to, on their annual plan, are going to come back to an update and a view on that, which we'll work with your all your consultants on. But as to this slide is a snapshot that includes that shift of assets out of equities into fixed income, and that does cause a shrinkage of duration. So I would urge you to think about it in two different ways. The dollar value of a basis point has gone up in each of those, so that means it has a higher riskiness to it and would perform better if that correlation remains negative. The second way to think about it is that amount of assets that we moved in, if we relabeled that instead of short-term duration, we just called it cash, or we called it, something else rather than decreasing your duration, all those gray bars would be significantly higher. So for teachers, for example, it shows 8.4. If we were to take out that short duration component, that pops up to 12, and you can kind of ratio it up for each system. But that's an example of where we stand, and if the wheels were to. Get back to your question. If the U.S. equity market stumbles, what's going to happen to this portfolio, to the treasuries? I don't know. The theory, what we all believed in, was that the negative correlation would exist. My own 2 cents, if the cause of the equity stumble is inflation, that both long duration bonds are going down in value and equities are going down in value. So it all gets down to what that correlation does over time. Over the past decade, in extreme distress in the U.S. equity market, long duration has performed extraordinarily well, and that's something that we all need to revisit, and certainly at the next strategic asset allocation will be, again, a topic of great interest.
Okay, all right, thanks. Any other questions for Alex? Okay, thanks, Alex.
So I'm going to talk about a few of the public market asset classes performance in the quarter and the year end. On most of these slides, there's 3 different time frames. Starting on the left is the quarter to date, Q2. The middle column is fiscal year, and then the right column is 3-year trailing. First slide is your U.S. equity portfolio, and we wouldn't expect much deviation from the benchmarks as the vast majority of your portfolio is indexed. You can see BRRRR has a green bar sticking on the positive, outperforming the rest of them, and that all has to do with one of your mid-cap managers who's done very well. But if you look at the 3-year trailing numbers, you would expect us to be near the benchmark given the high proportion of your assets which are indexed. Small cap domestic is different. That's not all indexed, and you can see here teachers with a dramatic outperformance in all 3 time frames, and that comes down to Brown. And as a reminder, Brown is a very concentrated portfolio with the bulk of their assets in healthcare and technology, and they've just had an outstanding run. I would also, if you take your look to the 3-year trailing, Brown is also in police and fires portfolio. It's just a smaller percentage of your small cap portfolio. That's why your numbers aren't as strong. Mid-cap, as I mentioned, again, BRRRR's an outperformance, and that all gets into Wellington mid-cap, which has done just phenomenally well on all time frames. Police and fire also has Wellington, but you also have Iridian, which has underperformed, so it's dragged down the outperformance you got from Wellington. This is the relative performance for your EFI portfolio, and this is just a fabulous story for both the fiscal year and the 3-year trailing. Q2 was kind of right on benchmark. But this is really a story of three very strong managers in your portfolio: Bailey Gifford, Spruce Grove, and Acadian. And they have just had outstanding performance relative to the benchmark on fiscal year and 3-year trailing numbers. This is your total emerging market portfolio. So this is mostly active management, small part of passive. And the numbers here are not as positive. Quarter to date and year to date, we are slightly below benchmark. With Burrs being a little bit of a worse performer here. And this, if memory serves, was Acadian, who had a slightly larger bet on Turkey rather than the index, and that's caused some underperformance there. The 3-year trailing numbers, both wrapped around zero, not that much of deviation. And then I guess the only thing I forgot to mention at the beginning of this slide is the benchmark in here is the custom benchmark for each of your systems, because you do have different benchmarks that you use for emerging markets. Moving into fixed income, this is your structured fixed income, or we also call it your core fixed income portfolio. As a reminder, this is 50% your treasury portfolio, 60%, and 20% investment grade, 20% mortgages. And while your treasury portfolio is mostly indexed, your other two components have active management, but there's not much deviation in any of the time frames here, so those relative performances are all wrapped around zero as well. In high yield, slight underperformance in the quarter and the fiscal year. 3-year trailing, a little bit negative. Not a concern to us. It's really has to deal with what happened in the high yield market, and this was more of the junkier stuff in the junk market outperformed. So the triple Cs outperformed the better credits, and high yield as a whole also benefited in the fiscal year from rallies in the retail component and the energy component. And again, our managers are not we're not investing with the very aggressive managers. We're a little more conservative in this portfolio, so this is of little concern to us as well. Bank loans, not much to say here, but again, the same story in these credits with a driver within that market, and our managers are right around the benchmark. This is your ETI portfolio, and a reminder, the bulk of deviation from the benchmark happens with a duration mismatch between your portfolios and the index. ETI has a longer duration than the index, and so in a rising rate environment, you're going to expect ETI to underperform, as it has, and a falling rate environment, you would expect ETI to outperform, and that's more of the 3-year story. Hedge funds, a very positive story here for the systems who have hedge funds. The quarter to date was slightly negative, and there's a wide dispersion of returns, as you would expect with your hedge fund managers. Neil and team have put together a very uncorrelated portfolio. So for example, in the second quarter, the Alan Howard fund was up almost mid 30%, and they really captured that Italian bond trade in May when Italian spreads blew out. So a phenomenal quarter by that manager, and that's offset by a poor quarter by Faro, who got caught in the emerging market sell-off. So they underperformed dramatically versus the index. Just an example of the dispersion of returns within your portfolio. The fiscal year is outstanding, both on a relative and an absolute performance. On an absolute performance, it was up. Your direct portfolio was up 9%, which is the best fiscal year performance of that portfolio since the inception of the program. Just to highlight, again, for the systems who have hedge funds, you have it as a diversifier, an independent source of return, and a diversifier against public markets. And this is just to show you how well it did on an absolute basis and versus a global benchmark, which is that bottom row on here. So the global benchmark was up 7%, your portfolio up 9%, so you outperform public markets by quite a bit. And it's kind of doing exactly what it's supposed to do in a risk-off environment. So let me pause there. Any questions, comments on public markets before I turn it back over to Alex?
Looks good. Thanks.
Thanks, Mike. Now turning it to private markets. We begin here with OFI, and this shows performance since inception. What we're measuring here and in the subsequent slides for all of the private market asset classes is the PME spread. And as a reminder, the PME spread is the difference between the IRR and return of the portfolio versus what the systems could have achieved if they just had invested in the public markets using the same cash flow. So for OFI, you see the returns since inception for the 4 systems that are invested in opportunistic fixed income. We've seen over the last year plus some positive kind of momentum in OFI. That is driven by a few things. Certainly, the risk-on environment has certainly helped the lower-rated credits within your OFI portfolio. So you've seen some rebound in performance there. Certainly, the recovery in the energy market has been a big component of the turnaround in this portfolio, and the credits that we have exposure to in energy. And certainly, in a rising rate environment, the portfolio has seen some meaningful uplift given our exposure to floating rate notes in OFI. So PE, you are familiar with this chart. Once again, this is PME spread since inception for the 5 systems. Since inception, we are certainly below the target for PE, the benchmark, which is the public markets plus a 300 basis points illiquidity premium. But as we stated in the past, this snapshot doesn't really help us in terms of being nuanced enough as to some of the progress that has been made in the portfolio. So you'll remember from the last quarter, this next slide that helps tell a bit of the story for the private equity portfolio, and I think, frankly, for real estate as well, where we looked at 2011 as being the line of demarcation kind of pre and post, where the decision was made to change the underwriting strategy both in the PE and real estate portfolios, and you can see the performance of the portfolio pre and post. Now, just to explain this chart a bit, this is again PME spread, and we're looking at the spread or the performance versus the public markets on a vintage year basis. So if you look at the x-axis, you look at all of the vintage years. We've aggregated pre-2011, and then we have every year thereafter that is meaningful, 2015 being the last kind of meaningful year for the private asset classes. And on the x-axis, you're looking at the percent of either outperformance versus the public markets or underperformance if it's negative. And pre-2011 for PE, most of the systems were actually negative or underperformed the market, with the exception of FIRE, which was slightly positive. But since we've taken a different tact and course, and you've engaged new consultants in this asset class, you see the performance versus the public markets has been consistently positive in the subsequent 5 vintage years of 2011 through 2015.
Just to be clear, that's not the benchmark, that's the PME itself, right?
PME, correct. So it's the public market equivalent.
Plus 300,
Plus
right?
300, exactly. And if you look at some of the detail below, you will see the actual spreads by systems, some of which, John, have been above 300, and some are below 300, but all positive and very positive performance. So I think, as we've been describing, actually for some time now, the momentum has been positive, the turnaround is actual, and it gives us comfort that we're heading in the right direction in PE.
For these 5 vintage years post 2011,
yes,
are any of the systems above the benchmark, or are all of them above the benchmark? Do you know the answer to that?
I would answer it this way. I don't know the exact answer to that in aggregate. In aggregate, the answer is no, because we are still anchored and weighed down by the legacy portfolio.
2011.
I think post 2011, post 2011, if you look at our primary relationships, which is another way that we have defined it, and it was actually, if you look at the way we anchored that definition at the beginning of 2011, so without any adjustments for funds that we would have added, John, subsequent to 2011, you will see see that every single system is either at or meaningfully above the 300 basis points illiquidity premium for the benchmark. So above benchmark, absolutely. And one last thing I'll mention, if you look at the proportion, this is important, the proportion of the managers in the private equity portfolio that are categorized as primary, you've seen that meaningfully ramp up to north of 65, 70% of now the proportion of the PE portfolio for each system being comprised of your primary managers, which are delivering above benchmark returns. So now we go to real estate non-core, and kind of a similar story when you aggregate the results since inception on a PME basis. You see BRRRR as a meaningful positive outlier. That is largely due to the timing of when they started investing in the asset class, which was in the spring of 2011. So they've benefited from the shift in strategy in real estate. So you see that performance there. And teachers and NICERS have also some outperformance versus the public markets, and some of the attribution of that has to do with one investment that we've discussed in the past with a New York City-based real estate manager. Now, looking at that PME analysis by vintage year again, for real estate, you see the same trends that we highlighted in PE. Once again, taking 2011 as that point of demarcation pre and post as to when strategies change in real estate. Underwriting was tightened. You see that pre-2011, there was underperformance against the public market equivalent for all systems, with the exception of teachers. And again, post-2011, seeing consistent outperformance on a vintage year basis year over year. Now we go to infra, which infrastructure has always post very strong results. It is one of the newer asset classes, probably the newest asset class in many of your portfolios, starting investing in late 2013. And here, as Petya Nikolova would say, so I'll channel her a bit, who unfortunately is not here today, it is still very early in the maturation of the infrastructure portfolio, but incredible and strong performance out of the gate for infra. When you measure the PME by vintage year, and we're looking again at the mature vintage years for this portfolio, which we think are 2013 and 2014, you see well above kind of benchmark performance on a vintage year basis. So it's still early. This is not where we would expect the infra portfolio to be at its maturity in terms of outperformance of the public markets, but off to a very strong start. And with that, we'll take any questions on the private markets.
Questions for Alex on private market? Where's the core real estate? Why only non-core?
You know what? It only selected is what we did and what we've done in the past. So certainly we can present the core as well, John.
Yeah, I think we want to get a comprehensive view.
Okay.
So
Very well.
get the good with the bad or whatever. Thanks. Okay. Thanks, Alex.
Thanks.
So is that it for the?
And that concludes the performance report for the second quarter and the fiscal year.
Great. Well, I'll deal with that. Okay, great. So I think that concludes the agenda for the public session. So with that, we will take entertain motions to enter executive session. So let's do it in the reverse order, starting with teachers. Is there a motion from the Teachers Board to enter executive session? Thank you, Dave. Is there a second?
Second.
Thank you, Susanna. Any discussion? All in favor? Is there a discussion, Mr. Dorsey?
Do you want to acknowledge the trustees that came in before we went?
Yeah. Sure. Okay, so I'm taking a halt at the suggestion of Mr. Dorset to allow trustees who came in subsequent to are taking the roll to introduce themselves. Any trustees? I know there's some over here.
For fire, Leroy McGinnis. Eddie Brown.
Thank you. Anyone else from fire? No. Police?
Joe Alejandro representing Pat Lynch, Mubarak Abdul-Jabbar, and John Puglisi.
Yeah. Merritt Riley from the PBA.
Okay. Anybody else?
Susanna Vickers from the New York City Controller's Office.
Anybody else? Okay.
Wait,
What's
no.
that? Oh.
Jennifer Konovitz from the Controller's Office.
Okay, Jennifer. Anybody else? Great, thank you. Okay, so we have a motion on the floor at the Teachers Board, made and seconded to enter executive session. Any discussion? All in favor of the motion at Teachers, please say aye. All opposed, please say nay. Any abstentions? Motion carries. At NYSERS, is there a motion to enter executive session?
So moved.
Thank you, Mr. Katzman. Is there a second?
Second.
Thank you, Mr. Dorsa. Any discussion? All in favor of the motion at NYSERS to enter executive session, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Motion carries. Excuse me. At police, is there a motion to enter executive session?
Motion to go into executive session.
Thank you, Mr. Alejandro. Is there a second?
Second.
Thank you. I couldn't see who made the second. Who? Oh, Mr. Palladino. Thank you, Detective Palladino. Any discussion? All in favor of the motion at police to enter executive session, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Okay, motion carries. And at fire, is there a motion to enter executive session?
Motion to enter executive session, Leroy McGinnis.
Thank you. Leroy, is there a second? Mr. Brown, thank you. Any discussion? All in favor of the motion to enter executive session at fire, please say aye. Any other ayes over there? Aye. Okay, thank you. All opposed, please say nay. Any abstentions? Motion carries. Okay, we're now in executive session. I would ask members of the public and the media to exit the room, and we will take a 5-minute break. I'm advised that we'll take a 5-minute break.
The board took action on 2 private equity investments, the details of which will be disclosed upon contracting, and took action on 1 public equity investment, the details of which will be presented upon contracting. Can I have a motion to adjourn?
So moved.
Second?
Second.
All in favor?
Aye.
Any objections? Any abstentions? We're
in executive session, we heard presentations from 2 private equity firms. Consensus was reached on both investments, which will be announced at the appropriate time. We also heard a presentation from an international manager, equity manager. Consensus was reached, which will be announced at the appropriate time.
Any other further business before the board today? Seeing none, I believe a motion to adjourn is in order. So moved. Mr. Brown, second. Second. Mr. Kaczynski, all in favor?
Aye.
Aye. Thank you very much. We're adjourned.
Okay. Hi, everyone. As a follow-up to some discussions at the Board of Trustees meeting on Thursday, BIM staff has prepared some talking points and summary ideas about our current emerging markets country stream policy and process, and some suggestions for thinking about how we could move forward. So I just want to introduce John Mersberg and Tatiana Pahuski to come and address the board. Yeah, we can. Yeah, you want to switch in here with Cindy?
So I'll reference the PowerPoint that was handed out. I would say from an investment perspective, we think the emerging markets country exclusion process has some shortcomings. For starters, it raises some asset allocation issues, since about 30% of the standard index is made up of China, and we expect that percentage to get larger over time as MSCI adds more China A shares into the index. So first, that kind of raises the question, should Callan model the emerging markets part of the asset allocation without China? Just feel we're potentially making an asset allocation based on a factor, and then that country isn't in the index, so that's a potential problem. We also think that the limitations of the country exclusions don't allow NYSERS to maximize returns. compared to other systems, it's reduced the active manager's ability to add value, and it's created some significant tracking error over some short time frames. If you turn to the next slide, what this does is compare active managers that NYSERS have and other city systems have. And it compares their excess return versus their particular benchmark. So for the first manager, Acadian, it's against the custom benchmark. You'll see that over a long time period, Acadian has been able to add 87 basis points in excess returns. However, for the other systems that don't have country exclusions, they were able to add 137 basis points. That's the difference of the 50. So in a way, NYSERS active managers can't add as much value. That's one example. The next one down, Bailey, you'll see there's a difference of 140 basis points. And again, that's over 10 years compounded, so that's, I think, not insignificant. Next one, DFA was of the four managers here, was the only one that actually added a little bit more value at NYSERS, but it was only a difference of 13 basis points. And then the last manager on the list, Parametric, only has a 5-year history, but there again, their performance was 90 basis points worse versus the standard benchmark. And then looking over on the right-hand side, it shows you the difference, the trailing year difference in performance between the standard MSCI index and NYSERS custom index. You'll notice that, and these are all as of the end of the fiscal year, June 30th, 2018. The trailing 1 year is a difference of 590 basis points. That's a significant, tracking error to a standard index. You'll notice that over the 10 years, they're actually pretty close. The custom index is actually 3 basis points ahead of the standard index. But we think, and Tatiana can talk about it a little bit more, part of the run-up in China, back when they're importing a lot and building their infrastructure, also had a positive impact on other emerging markets that were, say, suppliers of raw materials. But we don't know that that's necessarily going to continue, as China's in a different phase in its development. I'll pause to see if there are any questions.
Oh, yeah, I have another question. My understanding was that the FTSE Custom NYSERS All Emerging Index is a NYSERS custom, is a version customized for NYSERS of the FTSE Emerging Market Index.
Which would also include China itself. We can give that to you.
Right, but what you're doing here is you're comparing the FTSE Custom NYSERS Index to the MSCI Emerging Markets.
I can get you we also have the MSCI Custom that we have here passive. I can pull up that data now if you'd like to see. There are some differences between the two, given that the MSCI, there's less names in the MSCI index than the FTSE.
Right, but I would note that the countries in the indexes are the same, and these are, in terms of the active managers, they're not limited to what's in the MSCI or the FTSE index. So long as it's a company in an approved country, they can invest.
When you're using benchmarks, you have to use the right benchmarks, and you have to compare them properly. And if you had looked at these carefully, you would have noticed that on the 10 year, right, the NYSERS FTSE customized index actually outperformed by 3 basis points.
But I would,
right.
But the argument,
and the argument is that in the past 5 years, it has not outperformed.
But I mean, the argument to that is that that's backward looking, and as we look forward, the concern is you're seeing a bifurcation in emerging markets in terms of where capital is being deployed, in terms of where technologies is being deployed. And I will say in FTSE and even in your MSCI custom, where you're sort of doubling up on exposure are places like Brazil, et cetera, that tend to be much more natural resources heavy. And so you're going to end up with an index that's more on the natural resources side, that's more cyclical in nature, versus what the MSCI actual index is. As you put in technology, et cetera, within China, within other countries, within India, you're basically going to IT that you're not gonna get at, within emerging markets that you're not gonna see.
And really, the argument on the right side here, it's just to show the difference. It's to show the tracking error. It's to show that, you know, the asset allocation is based on one thing, but on the ground, we're not able to invest in that. It's really just show the differences. The impact on performance is really on the left-hand side of the page when you look at the manager, the active manager performance.
Can I ask a question? In this comparison, where are we accounting for risk?
This comparison really just shows the returns.
Okay.
We could do some analysis on standard deviation and other things. We could certainly present that to them.
I mean, I will tell you, Bailey, when they try and run your portfolio versus the police and fire, they actually try and match the risk characteristics. Where you're gonna not get is the growth characteristics, because they're just not finding the same sort of ability to invest. You know, these guys are big tech bulls, and you're not gonna find that, you know, in Korea, what Ringley is at Samsung. And you're gonna compare that to an Alibaba or a Tencent, that's a hardware semiconductor company versus, you know, services company. And so it's a very different set, and they've tried actually very hard. They've put other people within the team. They actually have a guy who's from their Asia fund brought along to help this product and really trying to make sure you can match performance and the screen and in terms of risk. And they've done a good job of sort of matching the risk characteristics. You're just not getting the same juice.
How does this comport though with our investment police department and our just in terms of looking at?
We're gonna move forward with that. And I think from our perspective, what we wanted to come to you all with, and part of it's also, we're in the midst of an emerging market search right now. And so we're looking at these things, and we don't wanna come to you all, you know, we're looking at it the lens of right now, you don't like to invest in China. And so we know other systems do, so we're kind of looking at these guys in two lenses of saying, you know, if there's a manager that we think is great, but China's a big part of what they look at and what they see going forward, we can't necessarily we could recommend them to you, but we also know that you may not accept that. So from our perspective, we wanna, you know, and we wanna look at guys that actually have, and what we're gonna suggest to you all is a strong ESG ethos and a strong practice of it. Not going in and just buying MSCI data from them and saying, okay, I have a score. Someone that actually goes in, has their own teams, has their own philosophy about ESG, and actually works it within their portfolio. From a risk perspective, a company, Lazard is actually a manager for teachers. They don't allow China at this point either, but what Lazard does do is when a analyst suggests a stock and they come up with a stock price, and let's say they say there's 30% upside to the name, they think. The team then, with the PMs, goes through and actually puts sort of a risk ESG lens over it and say, okay, what are the risks at the country level? What's the risk at the currency level? What's the risk in terms of governance? What's the risk of social issues? And they haircut that target price based on those things. And so, you know, we like guys that are like that because we agree in EM there is still country risk versus developed markets. And so it's a question of how they use it and what do they think about it.
So Tatiana, can I just say, just following up on the risk questions, just going back to this chart on the right, hopefully I'll get this right. What I understood from some of our conversations is when we do asset allocation and Callan runs models that have risk and return assumptions embedded in, they run it against the MSCI Emerging Markets Index. But because we have country exclusions, what we're investing in is this FTSE custom index. So, like if we want to have a conversation about risk, we're using data from an index that we're not investing in. So that's sort of the disconnect in talking about risk from an asset allocation point of view, and that might be, a discussion point about how we are envisioning this country screen going forward.
I would say though, Susanna, that if we look out, when we do our projections for any asset class, it's 10-year forward-looking projections, there is going to be minimal difference in custom index.
But a question to that is though, when you've done your asset, you're looking at, 10 years out, China might be its own asset allocation sleeve, similar to the US, because it could be 50% of the EM index at some point.
Right, my point though is that asset allocation is it's a broad, making sure you get the right mix of mainly stocks and bonds. And then at the margin, you're drilling it down into the sub-asset classes. So I don't think that it has a big impact on asset allocation, is my point.
So, looking at these returns and, matching it against police, clearly on the left side of the chart, there has been a lowering of returns, excess returns. But part of what we try to do is, looking at a 30-year time horizon, the challenge zone and projection, it's a much longer period of time. And it's hard to look at this. I mean, as I was doing this, I got a flash on Bloomberg that China's stocks dropped to the lowest level in nearly 4 years. I mean, the EM markets as a whole, whether it's Turkey, Argentina, are having tough times. And that's the last shorter period of time, right? It's hard to ignore the fact that we have these, some of these, and whether this is the right way of doing it or not is I think, even a second question. But I don't think just looking at returns without looking at the risk concerns that we've asked about is necessarily a bad thing. And, returns, yes, we want to maximize returns, but without looking at the full market cycle, whether it's 4 years, 8 years, 10 years, we've used 10 years because that kind of gives us a much longer view. China's changed in 10 years. It will change again. We don't know which direction.
What I would argue with that is, you're taking on their market sophistication versus even in India, which you do invest in, is much higher. What you are going to see, and you're going to see more volatility in China because it has a huge, the Chinese government is trying to get more retail investing. Most retail investors, their time horizon for investing is a month. And so what I would say though, as a long-term investor, and we try to go with managers and we choose managers that have the same time horizon that you have, we want people that look through the noise and will look at it and say, okay, this is a time to step up and actually put more money into the market because we see the dislocation. And we really, we don't want someone that comes to us that says we have a 12-month time horizon. We much rather say they invest along, like Bailey's a perfect example. They own these companies, they want to try and own them for 5 to 10 years. And I think, that's the point, is sort of being able to have those types of people for you that will step up during times when it looks risky, but it tends to turn to be a good payoff time. I will say, one of my first huge downturns in the market was during the Asian crisis when I was a bank analyst. And it was a painful couple, 6 months, 9 months. I think that type of contagion type idea is not necessarily, in my opinion, in the same sort of bucket that you would have seen in the late 90s. I think for China, it's much more for their standpoint. It's, Trump's doing, but also internally, how they've cracked down on consumption, basically because of VIP spending, et cetera. And so they're sort of working through those issues of how do they drum up domestic consumption? Because that's how their country's going to grow, vis-a-vis 20 years ago when it was all infra-built. And so I think what the point for us is you're missing out on a very dynamic and increasingly sophisticated economy that's going to be a huge part of others' investable universe. And so, you can, and from our perspective, that's the point, is to hire people that understand what you're concerned about and are able to find those companies that will avoid those pitfalls.
I think that's exactly it. I think the board has valid, risk concerns, but to a certain extent, that applies, at the company level, not at the country level. I think, there are companies in China, I think, NYSERS, based on their principles would have no problem with. There are others that they would have problems with. But you could also be investing in emerging market companies where just because the country is allowed, but you'd never want the company. So I think it's really, the country exclusion is a little bit too blunt of an instrument.
Although you have a problem with China because you have no rule of law. And the Chinese government, and by fiat, can change the entire specter in the country at the drop of a hat, and they've done it in the past.
But just indulge me, if we could just go to slide 4, and especially for new trustees trustees who maybe weren't here when the original country screening process was adopted. I think it's just, John's first point, I think, is a really important one.
Yeah, basically just, it's time to reevaluate the use of the country exclusions. Is excluding countries the proper way to address the board concerns? I mean, markets have changed and developed since the initial country exclusions. More data is available at the company level. So, we really think we should reevaluate if excluding countries is the best way to move forward.
There are countries there that my organization will just no way in hell ever touch, like Russia and, and frankly, China. China's not a friendly country to labor. So that's really problematic for me to go to Henry Garrido and say, we're going to invest in China now. I mean, I know we invest in China already, but
I think
some
no
immigrants-
one is saying that it's a fait accompli that we would recommend specific investments in China or Russia or Pakistan, wherever. But what I think we wanted to discuss is how can we best do an evaluation of appropriate investments. So right now, our active managers in this space are forbidden to even look at companies in a certain list of countries. Maybe there are exceptions in China or in who's the other example you used?
Russia.
I have to say, most of our managers, Russia freaks them out.
Yeah, so-
Because they're actually more concerned about them versus China, because China, to keep stability in their country, because right now the Chinese populace is happy with wealth.
Right.
They're not really concerned about
So-
freedom, they're about wealth.
Right.
Versus Russia's like a mess.
Yeah, so I just wanted to make the point that just because we have a different lens, we're not saying that, our investment thesis is to rush head on into these companies. It's just, a very specific question. We just passed investment beliefs. The board has been able to articulate their priorities and concerns. Is this country screen process that was first put into practice, a decade ago, when the landscape was very different, is that the appropriate thing to do going forward? And unfortunately, we've been asked to decide, certain things on a time frame that may preclude us from, doing the kind of discussion or tweaking that we want to do. So I think, the reason that these guys are here is to bring up these issues and to give a possible alternative, which is on the next slide. And then the board really needs to discuss direction and how we want to tackle this policy.
So on the last slide, we propose a possibility of, instead of the country exclusion, instruct them, the board instruct them to look for active managers that have ESG as, part of their investment process, ingrained in the investment process. Provide NYSER's investment principles and beliefs to the managers to help them guide in stock selection. I mean, this is something that wouldn't be suitable for a passive index manager or a highly quantitative manager. And then we could hire a third party or consultant to review the results and see if it's ensure that's meeting the board's desires in terms of risk.
Question about that, if this isn't suitable for passive investment, clearly, the index is formed. Would you suggest, though, then, there'll be two different plans, one for the passive investment program, and one to allow?
No, we would suggest you be 100% active, because you couldn't
Right now,
implement
you're 100%
passive.
Right now, you're 30% passive.
Right, so this would do away, theoretically, we're not making decisions today,
Right,
the
right,
public
right.
can watch this, we're not making decisions, but theoretically, one could go 100% active with these additional overlay of instructions and guidelines, principles, and not have to have complete restricted lists.
Right, in theory you could, and we, you know, I mean, we see if we can find enough active managers with capacity that could implement the board's, you know, principles and beliefs.
Have you, without naming names, once again, in public session, have you looked at the managers who have good ESG records and looked at their underlying portfolios, and you're relatively confident that there's nothing on the list that we would look at, point fingers and say, as Ray just said, there's no way we would invest in that?
Well, we start out by looking for good managers, and then, you know, given the consultant process, so we start out with good managers, and then we'll look for ESG that could do what NYSERDA
Look, you're
would
gonna,
desire.
full disclosure, and we'll put this more about in developed markets, some of our guys own Volkswagen. You know, and that was a debacle. You're gonna have that in any market. You're gonna sometimes have one name that has issues. But their whole point is to try to avoid them as fast as possible. And, you know, I think that's, from our standpoint, is finding guys who have the same, close enough aligning beliefs with you. We're not going out and hiring cowboys that are out there that are just trying to make a buck no matter what. You know, these guys, for the most part, we like conservative managers who think smartly about things, who aren't, you know, swinging for the fences. And they, you know, we want them to sort of compound the return for you.
So I can get back to this. You know those conservative managers who have ESG protocols. You know, to take a look at their portfolio. Now, they don't have our investment principles, and therefore they're not subject to them. But if you were to review their underlying portfolios, representative portfolios, and took a look and said, there's 20 companies there that have horrible labor practices, how did those get in? That would be useful for us. Or no, that we looked at it and there were none, so it actually aligns with a lot of the concerns that you have. How did they get there? They had a good ESG program. So, you know, it would be easier to understand this in a real world than this.
And we'd be happy to bring some people in, like we'd be happy to bring one I've mentioned before who has a huge China exposure, who'd love to come talk to you all.
Well, I even think staff could look at those portfolios
Yeah, absolutely.
and say, we've looked through their China holdings and there's never been any accusation of child labor, of problems. I'm not suggesting that takes care of all the problems, because we have this, we share with D637 and others these same concerns. But I think that it gets you closer to say, this is a program that if we had had it, that would have resulted in the same type of concerns, you know, addressing the same kind of concerns.
And we would argue also, I think ESG has evolved. You know, I was at a firm in 2006, and it was like you just kind of signed it and you did stuff. And I think from our perspective, just because you would sign you're a signatory to the PRI, we think that's meaningless. And so we want to make sure that we're really look that you have a program. As I said, we tend to prefer people that aren't just buying a bunch of data from third parties and putting it together. Because I have to tell you, talking to enough people, the data is not very good either that you're buying from people. And so we want people that really want to think about it themselves and think about it holistically and from an investment standpoint too, and understanding how it works. And so we've seen, you know, we've met with people, not just for emerging markets, but ESG teams at large firms and how they're really thinking about incorporating it into their investment process.
And I think what you're talking about, if you turn to the last slide, that's really kind of the next step. We want to try to evaluate the feasibility, you know, of using active managers with ESG as part of the process to address the board's concerns. So we can go ahead and try to, you know, look at that and evaluate it and report back to the board.
And we'll do it within the lens of right now during our search, we're starting to do our due diligence trips. We're happy to sit down and really dig down with them and making sure of how they're doing that.
And just in terms of, you know, a third party, which I think would be additive to the process that BAM is, is suggesting, is that, you know, there are firms that we work presently with who have a focus on specific parts of ESG, you know, the S, labor. There may be other concerns that other vendors are able to help guide us with, and I think at this point, the way most of those outfits work is they go through and they have the ability to look at company by company ratings and experiences. They have people on the ground in different countries, and so, you know, they know on a very micro level if the supplier that this, you know, tire company is using to get its rubber, whether they're using child labor or slave labor, or, you know, how they're paying their workers or what the conditions are, instead of just, you know, sort of the broad strokes of an So I don't know, I mean, I would suggest what we've done with another board is bringing some of those vendors in to present to the board, to tell us what their capabilities are and, you know, how they answer these questions for other clients.
Well, I think you have to.
This is Andy. Just a couple comments, if I could.
Yeah.
This is a great investment discussion, and BAM staff has done a great job in describing the investment implications of this. Because, yeah, from an investment theory point of view, you restrict a universe and your volatility should go up, your tracking error will go up, and everything they said is absolutely true. But when we started this project, it was not necessarily an investment argument that we were grappling with. And so, you know, I'll agree with everything that BAM has said. From an investment case, the country screen, you know, I initially thought was kind of, you know, maybe not the best way. You know, I've gone full circle in terms of, you know, as a practitioner, I didn't want to restrict the universe. But then you read a couple of the country reports from Verite, and you can see that, you know, investment managers may not address the specific risks that the board was concerned with, specifically around labor practices. So when Tatiana said about, you know, when an ESG manager looks at a company, sure, you know, if they use slave labor and they're trading at 17 times earning, maybe you don't buy that. But, you know, most investment managers might buy it at 10 times earnings. And so if you can find alignment between the investment manager and the desires of the board, that is great. And there are managers out there. I will say that when we did the recent emerging market search, that was not part of the RFP. So, you know, there are some managers in there with an ESG component, but I won't say that any of your candidates would satisfy, you know, the desires of the board. But they are out there, and we can certainly build a structure like that.
I mean, but Andy,
gonna
Andy, in our DDQ, we have we've had it for 5 years now, extensive ESG questions. And as a staff, we actually sit down, and when they do answer that and they do claim that this is what they do, we sort of hammer them on it and try and figure out what's going on.
I think what Angie's saying though is when we did the search, that was not part of the search criteria.
This current search?
Yeah. Right, but
You
the
know,
search
and
criteria were managers who can add value. That's where we want to start.
Right. And I think because other boards, you know, we're in the midst of the EM search, correct? We haven't finalized anything.
Well, the short list is going to be finalized. So the consultants, there's no more, the consultants can't.
Okay, because are the short lists different?
We might want to take this into executive session as we're starting to get into details on hiring. So if we can table this part of the discussion, that would be probably a good idea until we go back into executive session. I would just also think, you know, going back to Isaac's point about risk assessments, you know, it's really important to make sure that overlay, the country risks assessments are in there, the legal risk assessments. ESG is a component, but it really doesn't address country risk and legal risk. And that's...
I'm sorry, and I would encourage the board to really differentiate between statistical risk and non-financial risk. Because the project, as I understood it, you know, the EM country screen was not a exercise in statistical or portfolio risk.
Can we also, just something to keep in mind, we're open to providing this for you all. You know, some of these countries like China has really evolved in the past 10 years in terms of their political structure and just in terms of the way the party is looking at things. And we would love to bring people in to give you education on that if you're open to that. We would love to have it, you know, because I think, you know, you hear the headlines, but to hear people actually who talk to these party leaders who understand what's going on and can kind of give you an insight from sort of, we all look like this, and if they can give you a little lower down, we'd love to provide that for you, just so you can understand, you know, maybe how it's evolving as a country and what you know, it can change on a dime, but just sort of understanding what these people plans in place are. Because it's, you know, from my experience, and I worked at a firm that had a woman that was quite tied in with the government and would do these 10-year views, etc. These guys are very thoughtful at what they're doing, and everything they've done has, and we're just focusing on China, but it's a huge part of the index. Out of most emerging market countries, they are very thoughtful about what their plans are. And I'm not saying there's not evil portions to that or whatnot, but there is some thought behind it. And I think if you guys wanted to meet with people to help you understand that, just so you can get a better view versus just what's in the news, we'd be happy to provide that for you guys.
I'd also be just quickly curious to see, with this exploratory process, how much of that growth will we be able to tap into with this kind of pivot, and how much of that growth will be inaccessible to us because of those ESG restrictions? Because it could be also that no matter what we do, we'd have to jettison ESG completely in order to really get the bulk of where those returns are, or it could be not.
Well, I mean, the question to you is, and this is strictly for EM, but some of these guys, an Alibaba or a Tencent, you're buying that versus a Google when you're in a global account. And if you're comfortable owning a Google, why aren't you comfortable with an Alibaba or a Tencent, or if you're comfortable with an Amazon? So it's a question of, just because where it's sitting, it might be the exact same kind of technology, et cetera, and in some ways it might be improving people's lives even more because you're taking a step up beyond, what's great about someone like Alibaba with Alipay. People don't have to go to these crooked state-owned banks anymore. They can actually put their money somewhere else. So there's different things you can look at and sort of.
Yeah, I'm just not sure what Alibaba's, family leave policies versus Google and other things. Right?
No,
but it could be that they're very much in line. That's why we would just want to see in order to be able to make that decision. And that's why this exploratory process seems like a good idea.
Right, and I think because some of those questions are so important, maybe certainly against maybe the potential managers might not have that granular view, but there are groups out there that just sort of these third-party vendors who their bread and butter is putting together the statistics of family leave policy, Alibaba versus Google. So, the idea was to see, if we want to bring in any of those outside vendors to address the board so we can get an idea of what's out there now that data is so much more available.
I think everybody here has raised great points. I actually did research on Chinese companies. I know it was a while ago. It was in the aughts, and getting good financial information, was very problematic. Now I know 2006, a lifetime ago, and so forth. But I also remember presentations here at BAM or at the SIM where I would ask point blank, just how good is the financial information on China, at a high level, and it was like, it wasn't unequivocal. The information is great. So I'm just saying I welcome the discussion to do a deeper dive there into information and the issues, and just how we could verify that Alibaba's family leave policies would compare to Apple. I mean, that's an exercise I would welcome, Susanna.
Dave?
I mean, just to point out that in terms of the hierarchy of priorities regarding labor practices in emerging market countries, it starts off with child and unfree labor, right? And that's where the bulk of it is concentrated, okay? And only after that, right, do you get to such things as conditions of work and the right to organize. And so I don't think that, while it was intended to make a point, and that was right, that that's not quite the territory we would be in. I would just point out factually that in Andy's proposed list for 2019, there is only one country which fails the labor circuit breaker, and that is Turkey. So, we're talking about the labor circuit breaker.
I don't understand, I'm sorry. when you say that Turkey fails,
Because you didn't read the document, that's right. That's right. There is only one country which is being excluded because it has a labor practices rating which rounds off to 1 and a negative forward-looking assessment, and that is Turkey.
So China didn't fail on labor.
That's right.
Yes, well, China did not fail only because they did not have a negative forward-looking indicator, because they do round to 1. So it's not like they're,
But
they're still on the bottom.
I mean, they're still on the bottom, but the point is, I think, as we talk to the companies that we talk to that do investing, they're trying to improve, and as we've said, the party knows that economic prosperity is what's gonna keep them in power. And so they need to let their citizens feel that they're experiencing economic prosperity.
And the expectations of the citizens have risen greatly as wealth has risen.
but Dave, so your point is,
Well, my point is, if I remember what my point is. For me, I was not here 15 years ago when this thing was adopted, right? But for me, the rational core of any exclusion of countries or of companies, right, is a question of, by blunt means, managing risk that managers may not be attuned to and able to manage by other means, right? And to me, that is first and foremost the risk involved in labor practices. The truth of the matter is that among the risks which we are involved in our scoring include matters which I believe that active managers who actually do analysis on the ground, not pure quants, right, would be alert to, country risks that they would be alert to, okay? And I don't know particularly why we score for those.
No, I'm curious and perhaps doubtful as to the ability of people on the ground in China to get, accurate information about Chinese companies. I mean, it's an authoritarian society. Media is highly controlled. The internet is rigidly censored. I mean, this is like, how much of it is a Potemkin village?
I mean, part of it, to be honest with you, a lot of what our guys are doing, they're looking to actually open offices there. They're hiring young, motivated Chinese themselves, native speakers. That's also an important thing to have. Bailey uses a service that does that, and they don't go through the media. They go and kick the tires, and there is this, we hear about the state itself, but the state also knows for survival, they need to help nurture this entrepreneurial side of the economy. And those entrepreneurials are younger. It's sort of the government, as long as they're not doing too much, they're sort of putting them at, keeping them at arm's length and letting them do what they need to do, because they realize they need technology and they need to compete with the US in terms of biotech, technology, et cetera. And so they need to give these guys some free reign to figure out stuff. And so I think you look and these are people that, when I talk to people, they find it, they're able to talk. In some ways it's easier to talk there than in a US company for the Reg FD.
well, I mean, I think
Well,
we should hear.
that would be an
I agree.
interesting.
Yeah, I
Sure.
think it is a very interesting question, and we should hear from the experts.
Yeah.
So, if we're wondering how managers are able to get that granular detail, let's ask managers. If we want to know how third-party validators can get that information, let's ask third-party validators.
I'll just say, I've not been here 15 years, 13, I think, over the years. I do remember a lot of these conversations early on, and I know over the last 5 years, 4.5 years, this comes up each year. And we keep moving this because there isn't one easy answer other than leave it alone. And I don't know if leaving it alone is the right move, given how the markets have changed so dramatically. To not invest in whole countries, and I think China is a special situation, but so is some of the others, Russia and others. would be akin to us not investing in the United States market because we don't want to be in fossil fuels. Yeah, it's, of course, you captured the problem.
Actually, it's because we don't want to be involved with Trump.
Right.
Would the US fail country screening?
Right.
Perhaps.
Right. So I think what we have to do is, what is the evil? It is the same thing when you do legislation. What is the evil we're trying to address? And the evil is clearly slave labor and bad labor practices, the rule of law, and the other indicators. The rule of law is a bigger problem because, you know, a country, an ESG manager may go into a company because they make the evaluation that, well, rule of law is a problem, but that's very academic. And they may not look at it quite the same. So I would be curious how they fact that in, not just in we check the box, yeah, there's somewhat of a rule of law, but how does that go into their evaluation? The second point the third point I want to make is, you know, we've made decisions here on the board for risk reasons. We're not in private prisons, the controllers of, resolution, certain gun manufacturers and retailers. We've made decisions that affect our own markets. They apply to international markets. There is no reason why, whether it's the investment guidelines or separate carve-outs, that we can't have an accepted agreement that companies that have very specific labor practices are just prohibited. Now, how that's put into play, how BAM would do it similar to the way you do divestment and others, I'd be curious. I mean, we don't have to answer that now. But whether there's ways to do that so that there are minimums. So the managers, we don't wake up one day and find out, yeah, we had these general rules, but the managers, just as Andy was just saying, it's just too good to miss.
Well, so I would say probably, Suzanne,
Yeah.
if you were to engage these third-party vendors to do the work for you and sort of come up with, and I know one you use now, does
Okay,
the
we
company-
need to not
Yeah,
discuss
yeah,
specific
yeah. Exactly.
vendors, so we can go, yeah, but I just wanna be
exactly.
careful.
That you could maybe hire them or task them with giving you what they think sort of the bottom of the barrel in terms of labor practices are within each country. And that's something we could work with our managers and say, you know, and this works much better with fundamental managers, quant guys, that can, you know, they can screen it, but it messes with their process. Because they sort of look, the bigger the universe for them, the better things are.
So two things that I just wanted to mention that, you know, exist today that are different than 13 or 15 years ago, you know, whenever this first started, is the board has recently adopted pretty extensive and specific investment beliefs. We didn't have those investment beliefs to telegraph to managers previously. You know, we had BAM interpreting what they thought, you know, were the beliefs of the board. But these are, you know, sort of clearly articulated beliefs that we can share. The second point is that as we go forward, I think we will have to think about monitoring very carefully. And if there's either subjective or objective criteria that we want managers to follow, currently we have a compliance operation here in the office that codes things like China. And that's just an easy yes or no, or, you know, check a box or not check a box, and that's something that they're able to monitor and they're able to oversee and alert when there's an inadvertent breach of that policy. If we are talking about, you know, sort of more loose ideas that, you know, we speak to more of a company level, and we hire third-party monitors, that might be, you know, sort of an annual exercise, or semi-annual, or an every 2-year kind of exercise. It wouldn't be the same, you know, sort of ongoing day after day monitoring. So, you know, I think we need to start thinking about directionally where we want to go and you know, what resources we need to start talking with.
No, I think that what Suzanne is saying is absolutely right. I think even the way we're looking at this is we're looking at this at the markets, but a lot of these same kind of questions are on developing markets and even our United States. It would be nice to know that these same investment principles are being applied in the same way, because we are going to pick up companies that might not be on the EM list, but maybe on our other list, that also engage in practices that we don't want to be. So looking at it from how to monitor the portfolio, we've said it time and time again, there are companies we're invested with, which the lion's share of labor is in China right now. we don't capture the review and the analysis because we don't check the box that they're a Chinese company. But those who do the analysis, they're going to say, yeah, you may be listed on the New York Stock Exchange or in London, but these are companies that have these risks associated with it, and you should talk to your managers about it. You know, let them know that this is a risk. So it is time that this board kind of figures out how to do this in a more efficacious way.
So next steps.
Well, I think I heard bringing in like experts on China.
Yeah,
and-
perhaps we should go into executive
Yeah.
session so we can discuss in further detail. If I could have a motion to go into executive session.
So moved.
Do I have a second?
Second.
All in favor?
Aye.
Any objections? Any abstentions? Okay, we're now in executive session.